What's up, world? Welcome to this episode of Ambition Today, which is going to be a little bit different than normal. So as someone who grew up in Buffalo, outside of New York City and Silicon Valley, I used to use books, blogs, Twitter, and podcasts to learn really anything I could about venture capital and startups. And I'm grateful to those who took the time back then to share what they were learning. So when I started this podcast, my goal was to share information that not everyone might have day-to-day access to. Living in New York City and running Founder Institute New York gave me access to some of the best founders and mentors in New York City. And so up to this point, I have shared their stories on this podcast. But there's more going on and more I want to share. And if you're listening from somewhere else in the world and not in New York City, you might not know that Founder Institute New York has a meetup group. I actually run this group and it has about 7,000 New York City founders right now. And so this month we had an incredibly informative event with Joe Daniels of McCarter in English, and we discussed the intersection of what's happening in the cryptocurrency world and the legal world. Joe Daniels is the co-chair of McCarter in English's Venture Capital and Emerging Growth practice, and he's done a few successful ICOs already. And for me, this event felt like information that needed to be shared. It felt like something exclusive that I was getting access to in New York City, and I wanted to include it on the podcast, so hopefully it can help those of you out there who need that information. The slides that Joe is going over during his talk are all up on the website, and if you want to follow along, they're packed with information. I highly recommend checking them out. There have been more regulatory changes in the crypto world than I honestly realized in recent months. And if you want to launch your own cryptocurrency or token, then you need to know how to do it the right way. So take a listen. I hope it helps. And stay curious, everyone.
These are the entrepreneurs, creators, investors, and builders who ambitiously change to the world. Explore the hardships and heroisms of everyday life while we reveal the key moments to leave behind a lasting legacy. This is Ambition Today with Kevin Siskar.
All right, awesome. Hey everyone, we're gonna get started here. Welcome to the Founder Institute Meetup for January. We're talking a little about cryptocurrency, ICOs, and the blockchain, and the legal ramifications of it in 2018. So we have an amazing one of our best mentors for Founder Institute here today, Joe Daniels, to talk to us about it from the legal perspective. So let's have a round of applause for our mentor tonight. So Joe is the co-chair of McCarter in English's Venture Capital and Emerging Growth Companies division. So thank you guys for hosting us here. Thank you for the drinks and the snacks and the awesome time. So we're going to hear from Joe. We're going to go through some of the legalities of crypto, and then we're going to open it up for questions and answers at the end. So if you have any questions, write them down, and we're excited to kind of dive into that and talk about it. Before I pass it off, I just want to get a sense of the room. How many people here own Bitcoin? Okay, how many people own Ethereum? How many people own Litecoin? How many people own Ripple? How many people own EOS? Okay, all right. And how many people are thinking about doing an ICO themselves? How many people are doing an ICO themselves? How many people have already done an ICO? Okay, all right, cool. So it's pretty good spread of the room there. So with that, I would like to pass it off to Joe. Let's have a big round of applause for Joe from McCarter in English. Round of applause. Woo!
Thank you. Am I amplified here?
You're amplified.
All right. So I just put this together in the past week or so, but I've been doing a lot of SAFT offerings and a lot of work in the space in the past 6 to 9 months. So let's just start with it. Crypto and blockchain law. So first, a little bit about us. I'd like to welcome you to this the FI Crypto and Blockchain Law event. My name is Joe Daniels. I'm the co-chair and a partner in the Venture Capital and Emerging Companies group at McCarter in English. McCarter is a full-service law firm of over about 450 lawyers in 9 offices across North America. My team at McCarter focuses on finding and representing the best startups in technology and life sciences. That includes a lot of crypto companies these days, and of course the founder-friendly VCs that invest in them. Specifically, we help the startups issue initial equity, develop intellectual property strategies, raise money in angel, venture capital, and other private rounds of financing, expand through acquisitions and partnerships and revenue transactions, basically acting as the outside general counsel to companies. And of course, exiting through M&A and IPOs. And we help the funds form and then make their investments. And we were recently ranked by PitchBook in the top 3 firms regionally, in the top 7 globally and nationally, and the top 6 in global early stage for completed VC deals in 2017. I think that's just through September 30. We should probably end up higher up the league tables. We're sort of expanding rapidly. As an example of what we did in the crypto space, we've worked on many SAFT and token offerings, including San Francisco-based Quantstamp, which just raised $30 million in its pre-sale, and a quasi ICO, and we're working on a few Regulation A token offerings. Quantstamp, I think, is number 88 on CoinMarketCap now, but it's got about $300 million market cap. I've personally been doing this for about 22 years, including 8 in the Silicon Valley and 13 years in New York. Here are some of the companies that I've represented in the past. Usually focus on high growth sectors like fintech and crypto, for example. And here's an example of some of the. Can you guys read this all the way in the back, by the way? Maybe with your phone or something, you can check it out. We're working with maybe 10, 20, we think, leading utility token companies, also security token companies in their offerings. So that's us. So first, what is blockchain? You can't read this, so I'll read what the boxes say. So on this one right here, an interaction between actors is being made. They're using a protocol that will let them record the data about this transaction on the blockchain. And over here, the interaction gets verified by all of the actors and is sent along. This box right here, the data in the interaction is encrypted and packed together with data of other interactions in a block. And then the new block is added to the chain, the existing blockchain, after being added as an encrypted copy of all the previous blocks. So a new block just gets added to the whole chain, right? Bringing user transparency, immutability, or non-changing substance, low transaction costs, and decentralization. The way I look at it, mostly from my perspective, is what are the different types of tokens or crypto that's out there. I categorize it into 3 groups: the intrinsic tokens, which Kevin has just mentioned, Bitcoin, Ethereum, Ripple, EOS, IOTA. They're usually the top coins in the CoinMarketCap listing, right? And then you have your application or utility tokens like Filecoin. That's a great example. Mates and Quantstamp are 2 from my clients, so I actually understand the business model, so I can actually talk about them. Filecoin is an example of they did an offering of about $250 million in August. And what they do is they basically offer up the storage capability of a decentralized network. The people who offer up the storage mine Filecoin, and then you can use the Filecoin to use the storage. And none of this is built yet. It's actually I think anticipated to take about 2 years to build. So what they did was a SAFT offering, knowing that their token was not fully functional and therefore was very likely going to be considered a security. It was sort of the prototypical securities offering of a token, but it's also a utility token. And Mates, those are being offered right now. The Augmate IO platform basically entitles enterprises to manage wearable devices, and then people who participate in that economy get rewarded or bonused tokens for participating in it, for using the Augmate platform. And then Quantstamp, it's interesting. You might have heard about the smart contract functionality of Ethereum. What this basically allows for, these smart contracts, is fully executable transactions without any sort of written binding contract and having to go to court if the person is not performing. For example, let's say we have a smart contract where I agree to perform a certain set of services in exchange for $10,000, and those services can actually be delivered digitally, right? Or somehow proof of the completion of the services can be determined digitally. Then with a smart contract, my performance of the service, the $10,000 is automatically transferred, perhaps in some form of cryptocurrency, right? So these smart contracts, unfortunately, are under the ERC20 or Ethereum protocol considered to be fairly vulnerable. For instance, I think the DAO token, where there was a $50 million hack, very, very sort of controversial and well-known hack in July of last year. That was an Ethereum-based system. And so what Quantstamp does is they've created a platform whereby a bunch of independent parties around the world can help to audit these smart contracts and identify securities vulnerabilities. So on the one end of the platform, you're sort of introducing your smart contracts for review, and then they're evaluated by this decentralized network. So the people who are auditing the contracts are mining Quantstamp, and then then they can sell that on an exchange to people who can then take the Quantstamp to verify or to identify security vulnerabilities in their smart contracts. And they recently raised $30 million in Ethereum. Now that's worth about 60. It used to be worth 100 about a week ago. And then you have these asset or security-backed tokens. A lot of people are talking about. To me, this is basically the same thing as replacing an existing security with a digital token, with cryptocurrency. So, for instance, when you have a real estate or a private equity fund, you basically usually create a limited partnership agreement, and then the people who invest in that fund get limited partnership interests. And instead, you might get something like a RealECoin. That's one of my clients. They're issuing these tokens which entitle the holder to the same types of economics that you would get in a real estate investment partnership. Dividends, distributions from income generated off of real estate, gain from the sale of the real estate, that sort of thing. So 3 types of tokens. So what is it? What is an ICO? This name is sort of bandied about, but it's basically a token sale when a company that's generating a blockchain component creates its own digital currency and sells that thing to raise money. It can take the form of a SAFT. We usually do that in the States now for reasons I'm going to get into, or a simple agreement for future token, so as to comply with U.S. securities laws. In the past, people have just been selling the token directly. So first, the company develops a technology with a specific use case based on blockchain, and instead of selling equity to raise money, which of course dilutes the ownership interest of the founders and the management team in whatever they're building, the company issues part of the tokens or the cryptocurrency for sale, usually at a discounted price initially and then at successively higher prices. And then the company holds part of the token supply in order to be able to have an effect on the market price, like the Federal Reserve Bank controls the money supply, they control the token supply, supply and demand, and with the cash that they get in return for the issuance of the token, they can then cover the further or the complete development of the technology that they're describing to people. Here's some data on ICOs or SAFT offerings. So, interestingly, from 2014 to 2016, there was only 300 million raised. But then in 2017, I think it reached about 3.4 billion, which exceeded venture capital investment by 2 to 3x in 2017. It's pretty significant. Also interesting is that the 4 biggest 2017 ICOs amounted to 1.1 billion of that total. Filecoin, like I mentioned, Tezos, EOS, Bancor, Satis. So in my estimation, I don't think there's any data on this, probably 3.2 billion of these deals were completely non-compliant with securities laws, at least as we understand them today. After the Dow report in the middle of last year, and especially with the Munchie case, and recent guidance, the SEC's out there making speeches and releasing reports and things, and giving us little snippets of guidance. So how could they have done that, right? How could they have gotten away with all that, and we're all finding out about it now when it's too late for us to do the same thing, right? That's sort of a good question, right? Well, they took the position that these tokens were not securities, that we could just refer to it as a contribution to a foundation, or they changed the words of describing the investment of money in a common enterprise and all that stuff. And they just tried to circumvent all these rules, knowingly or not knowingly. I'm sure they'd say that it was not knowing. And so that may create a significant problem for all the people that did all these token sales in the past in a non-compliant manner. For instance, if their token price drops significantly, right? When you do an IPO and the price drops significantly, you often get these class action securities lawsuits against the people that conducted the offering for the losses of the investors in the offering. When they invest at $10, it goes down to $2, they just lost 80% of their money, right? So what does it mean to be a security? It's complicated. Not so complicated when you're thinking about common stock trading on the New York Stock Exchange or NASDAQ for your typical technology company like Apple or Intel. That's just common stock, right? It entitles you to proceeds, distributions pro rata on all common stock. proceeds on liquidation. If Apple gets sold to Google, then they pay a certain dollar price per share. Everybody gets the same dollar price per share. That's the basic security, right? But there have been lots of other things, investment contracts, things people have created in order to basically raise money from people and put that to work, called investment contracts. And the whole theory of the investment contract is the one under which people have started to construe, or in fact the SEC has even concluded that tokens can be securities. So what is that? What is that test? It's the Howey test. You may have seen this before. It's an investment of money. People always lose on that part of the test. You have to raise money to even be interesting, right? And a common enterprise. What does that mean? So there's three types of commonality developed by the federal courts. There's horizontal commonality, which means you have a bunch of people pooling money from multiple different sources into one pie, and then that's meant to go do something. The management team is meant to go do something with that pool. There's also narrow commonality, where the efforts of the management team affect the return of at least one or individual people who have contributed money. And then there's something called broad commonality, which is where the management team affects the return of all of the investors. So it's a very complicated set of abstract definitions. But this one's easier to understand. And when we apply this to the facts, you'll see what common enterprise means. Usually people lose on this one too. Is led to expect profits. So again, just read it like a sentence. Makes an investment of money in a common enterprise being led to expect profits solely from the entrepreneurial or managerial efforts of the promoter or a third party. Led to expect profits, usually these days in the token context, means you're out there saying you're probably going to make 10 times your money on this token sale, because we're, number one, selling it at a 90% discount or a 50% discount. And secondly, as we build out the platform, probably more people are going to use it, and there's a fixed supply, so that probably means the price is going to go up, right? And obviously there's many different ways that you can hype your offering. And people have sort of gone to a new level in offering token sales in the past year to get those tokens sold. So that's one of the major elements. And then finally, perhaps most importantly, solely from the efforts of others. So what does that mean? So like in the Munchie case, the idea was people were going to mine whatever the Munchie token was called for making reviews of restaurants in San Francisco or wherever they began to operate. And then those tokens could be used to get discounts at those restaurants, right? But they hadn't developed that platform and nobody was really using it. So that means that the value of the token when after it was purchased pretty much depends upon the Munchie management team, the efforts of others for the appreciation to occur. So then we go back and we look at these 5 biggest ICOs in 2017 and think which ones of these were securities, right? Filecoin was definitely a security. Thankfully they used the SAFT and they comply with US securities laws, which I'll get into how people have to comply with that, what they have to do. Tezos used something called the Swiss Stiftung, which is a foundation. And I think the deal was that the tokens were sort of issued to people that bought them, but they were not released. They're held by the foundation until the platform became operational. So that was sort of compliant with US securities laws, at least in the beginning. And then you had EOS, Bancor, and Status. These were all direct token sales, but before the tokens were actually functional, before they had any utility independent of the efforts of others, and probably in an investment in a common enterprise. And they were probably led to expect profit. So these are questionable offerings, and if their tokens drop, they can have all sorts of issues. I'm not going to get into the details unless you ask me about it. So early in 2017, a bunch of securities lawyers began warning that these utility tokens, especially the asset-backed type of security token, which sort of promises a return of a certain amount, some of them promise a return, per week, per month, per quarter, could be deemed securities. And, we have to start looking at this and trying to, change the offering procedures, right? And then in July of 2017, there was this, around that time, $50 million were hacked from the ICO proceeds of this decentralized organization called the DAO, which was run by something called Slockit in Germany. Sort of like Sprockets, on the SNL, German, Does anybody get that? No. Okay. So just applying the test. They applied the same test I just went through. It was a common enterprise. The DAO raised money from many sources, that horizontal commonality, by token sale to engage in a for-profit business, which was to basically invest in things like venture capital investments and other investments that were voted on by the holders. So it's sort of marketed as, it's self-run. Like the holders of the tokens can decide where the investments are going to go, and then by majority vote or whatever it was, they would direct the money that was raised. The investors were also led to expect profits. The DAO marketed the tokens, saying that it would entitle the holders to distributions of profits from the investments that were actually made. And finally, fourth prong, derived from the entrepreneurial or managerial efforts of others. Slockit created forums to discuss the investments. It was like a management team, right? They worked to resolve this $50 million hack. They couldn't resolve it. It was gone. There was nothing they could do. But they figured that out. And they sort of created curators to control what proposals the token holders could vote on. So the token holders are not really running the thing. Slockit is sort of running where the investment dollars are going. And then secondly, the token holders could only vote on proposals pre-approved by the curators. They couldn't negotiate the deals, and they could not band together to exercise any control over the curators or to replace them. So they had no real governance. So therefore, the benefit to the DAO token holder, or the value of the token, was being determined by these Slockit guys and not by the token holders, right? And this prong of the test is generally always going to be failed by completely non-functional tokens, and then there's sort of a spectrum of functionality. So at some point, you can probably pretty clearly argue this is not a security because it has a utility that's completely independent from the efforts of others, right? It's a little bit on the Howey test. The takeaway from the DAO report is they basically announced to the world, you took a bunch of money from Americans, and it was a security, and a lot of these other token offerings could be securities too. So you better watch out. Okay.
Question.
Yep.
So what's the preferred method? Is it the direct, SAFT, or the other one?
I'm going to get to that. It might be a little confusing in the beginning. This is the first time I've given this, and so I'm not sure it flows perfectly, but we'll get there. So I always say there's basically three types of U.S. securities laws that you have to worry about if you're going to raise a bunch of money, like my client Quantstamp, which raised $30 million in 2 weeks and is now building their platform. Namely, number one, you need an exemption from or to register your securities with the U.S. SEC, right? Registration with the U.S. SEC in the typical IPO process is like a 6-month process, very expensive. You have to have audited financials, very difficult, right? Especially for a startup company, right? And then there's Regulation A, which takes 3 months. It's also pretty strenuous, arduous. Probably you have to draft this big book, file it with the SEC, all this stuff. You have to get audited financials for that too. So most people, what they do with any kind of securities offering for a startup is they get an exemption from the federal securities laws. And the exemption most people use is Reg D 506B or 506C. Reason being, these are geared towards an offering that are only made to accredited investors. Accredited investor in the United States is a person that has at least $1 million in net worth, excluding the equity in their house, or net income of $200,000 if you're single, $300,000 if you're married in the last 2 years. And the reason why most people use these exemptions is because the accredited investors have most of the money that you want to raise from. A lot of people have had some success raising from 10,000 people who contribute $5,000. But what is that? What is 10,000 times 5,000, Kevin? It's not that much, right? It's like $5 million.
Sorry, I was writing a question.
It's okay.
You beat me to it.
It's okay. So let's talk more about 506B or C. So if C just came out like a couple of years ago with the First Jobs Act, 506B, to comply, you have to make the offering only to accredited investors, and then you can only sell it to accredited investors. And the good news is you just have to get them to sign something, hopefully before they even receive the offer. If someone goes onto your website, you should have them confirm by checking a box, I'm this type of accredited investor, I have this net worth, I have this kind of income. You don't have to double check it. You don't have to do AML KYC. You just have to have them check a box. And then you show them the offering materials, and then when they invest, they have to reaffirm they're accredited. That's the way people used to do it. But that's not the way most people do it now, because most token and SAFT offerings are basically popularized through the internet on a bunch of websites, and that constitutes what we call a general solicitation, right? In other words, you're soliciting across a broad spectrum of individuals, whether or not they are accredited, by publishing the offering to everybody, right? And that's 506C. And sort of the added burden of 506C is that on the back end, before you close on the money, you're supposed to have a third party, like an accountant, in fact, only an accountant, a lawyer, or a broker-dealer, verify that person's accredited status. Or you have somebody in your team, collect their tax returns, look at their bank statements, and verify. I've seen people verify like 2,000 people that way, and before they can invest. Or before they might even wire in the money, but you have to, check these details before you can actually start using the money or closing on that offering. And we do these deals all the time. Again, most of the token and SAFT deals are 506C offerings. It's not that hard, right? If you think about it, what I just said is not that big of a deal, right? Anybody? Not that big of a deal, right?
Seems hard.
Why?
I mean, you gotta wait around for a long time. You presumably already announced that so it gives competitive advantage to others. I mean, since it's such a greenfield territory, you don't know whether you'll end up getting a yes or no from a governing entity.
Okay, but you don't have to send anything to a governing entity. That's
You don't have to register with the SEC? Is that not?
Yeah, that's what I was saying. Is you avoid the registration by going this 506B or C route, and you just, even if you do a full-blown general solicitation, you just have to verify that these people are accredited before you take and start using their money.
Okay.
That's all. Not that big of a deal, if you think about it. And there's all kinds of third-party people that offer services online, so they'll check it for you, like verifyinvestor.com. It's not my company, but it just has a catchy name. Okay, so three more. There's like three issues, right, from the U.S. securities laws. The second one is, even if you have an exemption from registration, which is good, and if you fail, like you raise $30 million, try to build your platform for a couple of years, your team, fights with itself and can never make any decision. For whatever reason, it doesn't get built the way that you described it is going to be. And yet you marketed it that way in the middle of the offering, and everybody gave you $30 million thinking you were going to build this and that their tokens were going to be worth a lot of money. Okay? So very often in those circumstances, the people that just lost their $30 million will sue the company for the $30 million, maybe more. And if the company doesn't have any money, they'll try to go after the directors and the officers, which is probably you. And that's what director and officer insurance is for, and indemnification agreements, and that is exactly what it's for. That's in fact, and you should get that, especially if you raise $30 million. But how can you avoid the fraud claims being successful? In this market, I never recommend this in like your typical venture capital or angel offering for a technology company or a life sciences company, because these people are supposed to be big and they understand the risks and they know what they're doing, and they very seldom sue when they lose all their money. A venture capital firm doesn't go around suing the people that burnt. I mean, they had a seat on the board. I mean, their reputation was on the line just as much as the company. They usually don't sue the companies that lost all their money, right? But in this market, you don't know where your token buyers are coming from, so I recommend generally something called a PPM. And not a big full-blown Goldman Sachs or Morgan Stanley PPM that's like this thick and rooms of lawyers and bankers and accountants pour through for 2 months, but rather 16 pages, mostly consisting of risk factors, most of which are boilerplate, which just explain that basically you're just totally risking your money here. We have no idea if we're ever going to build this thing. Even if we do, there's a zillion competitors and more resources, on and on. And then it becomes difficult for those people that gave you $30 million if you fail to go into court because you say, Your Honor, I told them about all the risks in advance, right here, Exhibit A, right? And then finally, there's a sort of complicated one, the resale issue. Okay, in the United States, I can tell you why. There's a policy reason why that originated back in 1933, which was the 20th century, right? Before World War II, right? Quite some time ago. The basic idea is that if you sell in one of these private placements under 506 securities to a bunch of token holders in the U.S. or anywhere, they can't resell those tokens into the United States for 1 year. Okay, but what happens in all these token sales, like not Filecoin, but EOS, for example? They sold the tokens. A lot of them were sold to people overseas. A lot of them were sold in the U.S. Some of these new token exchanges picked them up and listed them on the exchange without them even doing anything, trying to make an application or anything, right? Others, like Kraken, Bittrex, EOS applied to be listed there. And they might have even requested a legal opinion that said that they're not a security. And some, probably, person not very well versed in securities laws gave them that opinion, right? And they began to trade. Because they're freely trading on these exchanges, that means any U.S. person can buy those tokens. And the problem with that is that let's say the EOS token starts at $1 at the ICO. And then when Smart Guy decides to liquidate his token position that he bought in the ICO, sells at 100, 10 Americans buy those tokens at 100, right? But then it drops to 50, and those Americans lose half their money. Those Americans can then sue the seller of that token and the company for rescission. I want my money back. I want my $100 back per token, right? That's the rule. So how do you fix all these problems and still conduct a token offering in today's environment? Did I go through the Munchie thing yet? Yeah. There's the Munchie. Well, I'll tell you the solution before I give you the problem. It's the simple agreement for future token plus PPM, right? The simple agreement for future token, if you treat it as a SAFT, if you treat it as a security, you sell it only to those accredited investors, and you get the appropriate verification and certification on the back or the front end as appropriate. Then you take care of securities laws issue number 1. PPM, you take care of 2. Resale, you just make sure that the SAFT cannot convert until the later of 1 year after the date that you first sell the SAFT or platform launch. Or you can make it the earlier of if you want. So that when basically you get to decide. If I think this token is fully functional, has utility completely independent from me and my team, and I can go to the SEC and say, this is not a security, and they're going to agree. Or I can get someone to give me a legal opinion, do the really in-depth analysis and sort of shore up that position. Then you convert the SAFT. Then you don't have a resale issue because people are not reselling a security into the United States. They're just selling a token. They're like the kind that you get at the video game arcade. There's nothing wrong with selling video game arcade tokens in the US, right? So the SAFT is sort of a solution to all three of these problems, and that's why it was used in Filecoin. It was engineered specifically for Filecoin. And it's very much caught on in the US capital markets, and now anybody who wants to at least be is slightly risk averse is usually going to use a SAFT to do their offering. SAFT usually converts at a discount to the eventual ICO price, but usually at the ICO, when you're doing it this way, you just sell another SAFT, you just sell it at full face value. So in other words, in the pre-sale, you sell a SAFT with like a 50% discount to the ICO price, and then you sell it at the full ICO price in the ICO. It's still the same SAFT. Can I take a picture? Are you going to give that to the SEC? That's okay. I'm ready.
This is Ambition Today.
If you enjoy Ambition Today, then please leave us a review in the iTunes Store or Apple Podcasts, as it's now known. If you don't know how to do that, you can just visit syscar.co/review, and I'll show you how to leave a review in 3 quick steps. Thank you so much for the help. Ambition Today is also happy to partner with WeWork, a co-working space that lets you do what you love. WeWork currently has offices in over 140 locations worldwide, and many of our portfolio companies, the founders love using WeWork for their startups. So they can do everything from one-person offices to full-team offices. Check out syscar.co/WeWork to learn more. And the Founder Institute, the world's premier idea stage startup accelerator. The Founder Institute has graduated over 2,700 technology companies across 6 continents, and we've learned a lot from those processes. We actually just had the CEO and founder, Adeo Resi, on the podcast a few weeks ago, if you want to go check out that episode. But we've used that data to compile the best personality traits of successful founders, such as fluid intelligence, openness, conscientiousness, and more. And so if you think you have entrepreneurial DNA and you want to find out what your personality profile is, you can visit fi.co/join/ambition to take the test and find out today. And now back to this episode of Ambition Today.
Visit Ambition Today online at syscard.co and follow the show on social media at Ambition Today.
Okay, so the SEC, Honorable SEC Chairman Clayton on November 9th said, so first I had the Dow thing in July, right? So then November 9th, the chairman comes out and says, there's a distinct lack of information on the exchanges and ICO offering platforms about the tokens that are trading on those platforms. What does that mean? Like, is he trying to regulate the exchanges like Kraken and Bittrex? And I thought about that, and I said he probably is, but the thing is, if the Kraken and Bittrex are only trading tokens that are not securities, then the SEC chairman has no jurisdiction. So he's basically telling us that down the road, they're going to start, by enforcement action or by case law or by even worse rulemaking, setting forth guidance that most tokens are securities, right? He's going to expand the realm of securities to include a lot more. So that when they are traded on an exchange, there has to be more publicly available information about them. Because in order for a token to trade on any kind of exchange, whether it's a licensed exchange or a NASDAQ, or you have to at least file an annual report every year, which has financial information, lots of information about the issue. So that was sort of a change. And then you get the Munchie cease and desist order on December 11th. And this is basically all just confirming what I was saying, that you should basically use a SAFT to solve your problems. So Munchie was this California-based company selling tokens to raise money to develop its blockchain-based food review service. Like I said, reviewers would be rewarded for reviews, and then restaurants could buy advertising with the tokens. So the reviewers sell their Munchie tokens on Kraken to the restaurants. They use those tokens to pay for advertising on Munchie. That's a pretty good idea, actually. It's a sort of a small market. I don't know why. But anyway, they just wanted to raise $15 million in a token sale. They did it as a direct token sale. This is on December 11th, just a little while ago. The stated purpose was to improve its iPhone app to get more users and get people starting to review. In the middle of the token sale, the SEC came to Munchie and proposed, and then Munchie agreed to an order, to basically a sort of an agreement that it was offering and selling unregistered securities without an exemption from registration. It was selling it to everybody, not just to accredited investors, right? And then they had to halt the offering, and then they had to give all the money back. I don't know how much they raised, but probably $7 million is my guess. So why did the SEC conclude that these tokens were securities? I'm just thinking back to my elements of the test. Yeah, I'll just go back. It was basically, this element was definitely satisfied, and these two were hit pretty hard. Investors were led to expect profits, and then it was non-functional. So, meaning, Munchie emphasized, and they quoted in the SEC report, emphasized that investors could expect that efforts by the company and others would lead to an increase in the value of the tokens. Hey, the more you use our service, the more the token's going to be valuable. So you might want to hold some in reserve, whatever. And they had people like really salesy marketing people on the team. It also emphasized that it would take steps, that Munchie would take steps to create and support a secondary market for the tokens. So that to them, freely trading the tokens in the aftermarket within that restricted 1-year period that I talked about was sort of important to their business model. So they said, no, you can't do that. And finally, it was non-functional. You couldn't yet take your token that you mined from doing a review one time and then sell it to somebody who wants to advertise on Munchie, right? It just wasn't there yet. So that sort of confirmed what everybody was thinking, starting back in January, and now the securities laws are pretty clear. These are the best practices, right? You do a SAFT and a PPM. You use 506B or C. You have 506B again, requires you to have investors self-certify that they are accredited before they even see the offering materials, right? And then for C, you can do a general solicitation to the entire world, widows and orphans, people who are not accredited. But before you take any money, you have to verify that the people that you're getting money from are accredited. The fraud issue has those risk factors I talked about, and with the resale issue is addressed by basically delaying the delivery of the tokens for a year. or at least until you know for sure it's not a security. Whether you get a legal opinion to that effect, or maybe the SEC issues guidance to that effect, explaining the rules that you better know that it's not a security by that time. And that does sort of put a damper on some people's plans, because they want to raise 20-30 million bucks and list it on Kraken immediately, and then they can dump all their advisor tokens, and even if they don't ever build the platform, they've just made millions of dollars, right? That's sort of creates a problem with that, right? But if you really do want to build a company, then this is the avenue. You can also register the offering, which is a shorter period of time than 1 year, right? You can use Reg A, which is sort of a short form, up to 50 million bucks. That takes about 3 months, in the best case scenario, and about 6 months for an S1, which is the same thing that people use for an IPO. And if you do register your offering, then the tokens will become freely tradable. But then my question becomes, and I'm sending people out to inquire with the exchanges that are out there. There's Huobi in China. There's all these different exchanges. Will those exchanges list a token that is registered as a security in the United States? Because they're not supposed to be trading registered U.S. securities when they're unlicensed in the United States. So they're violating U.S. law. Huobi is when they're allowing that to happen. So registering your offering is not necessarily going to be the most attractive thing either. I forgot to mention that if you have the SAFT converting 1 year after the issuance, then the way you comply with this 1 year restricted period, you still have to publish some public information, something akin to an annual report, but that's still much less than being a full public company. Also, if you register your offering on Form A or S1, you usually can't meet the NASDAQ or NYSE listing requirements, so you can't go on a real U.S. exchange. So this means you could potentially be cut out of the unlicensed exchanges and the national exchanges, so you can't trade. So what's the point? So that's, I think, why people are trying to create T0, the alternative trading system. Have you guys heard of T0?
No.
T0 is an alternative trading system that's not as fully regulated as National Securities Exchange, and it's being created by the people that founded Overstock.com. Have you heard of Overstock.com?
Yeah.
Okay. And I think their SAFT offering SAFE offering actually, an equity offering is launching on January 18 if you want to reserve some SAFE. Or finally, you could just do a token sale, just like all these other people did last year. But you better be sure it's a security, or you might end up like Munchie. And then how do you determine that? You're going to have to apply the Howey test. And there's a chart out there on the internet that actually quantitatively rates utility tokens created by Chad Warren Park and Fred Wilson and all these other people, quite some time ago now, before all this SEC guidance, which suggests that a lot of utility tokens would not be securities under a pure quantitative, you get 5 points for this and 1 point for that. But I would be very, very skeptical about the results of that quantitative analysis in light of the new SEC enforcement actions. And that's really all I've got. That's sort of the bare bones. And I wanted to talk about a couple of other. We still have some time?
Yeah.
Yeah. Other regulatory issues associated with crypto. I guess I talked about where can the tokens trade. Another thing is that if you do a token sale or you do a SAFT offering and you have more than 2,000 purchasers, and keep in mind that when you do this SAFT offering in the U.S. only to accredited investors, I forgot to mention, you can actually sell to non-accredited investors outside the United States under something called Reg S. I totally forgot to put that in the presentation, but that is true. You can do a foreign offering to as many people as you want, whether or not they're accredited, and you just have to offer to under 506B or C in the U.S. at the same time. And if you do that, it becomes Chinese money. You have PRC, Hong Kong, Singapore, even South Koreans probably trying to get their crypto, their Ethereum and Bitcoin outside of South Korea now. They're looking for places to park their money. So it's very easy to get 2,000 token holders. If you do, then you have to register. If you're treating the token as a security, you have to register under U.S. rules anyway. And if you have 500 foreign purchasers who are non-accredited, then you have to register as well. So there's that, high number of token buyers concern that you should think about. And then you have the issues for the fund type issuers, which many people may not understand. Like if you if you're going to do a real estate investment token, where he raised like $101 million to invest in income properties in the Northeast or in Phoenix or in Miami or something, right? Sounds pretty good. That's fine, except you're an investment fund, and then you have to be regulated by this thing called the 1940 Act, and you have to apply to become an investment advisor and things like that. So when you start running a fund that's tokenized, you have these investment company concerns. There's also a lot of unlawful broker-dealer activity in the token space, crypto space. There's a lot of people doing the token offerings, giving people tokens to help them raise money from other investors. Advisor tokens just handed out to people. Oh, you introduced me to that guy that invested $5 million in Ethereum. Thank you very much. Here's 100,000 tokens. Okay. So, the issues are very complicated there. Has anybody ever seen this movie called American Hustle? Yeah, a couple people, right? I mean, that was pretty good. It's a pretty good movie, right? With Amy Adams.
Jennifer Lawrence, right?
So in American Hustle, the basic idea was, I think it was Amy Adams, to pretend to have a British accent and to be some kind of English aristocrat who was hanging out with this guy that had a hairpiece. You remember that guy's name?
No.
Okay. And the deal was that if you gave them 50 grand, they would help you raise 100 grand. Or 250, right? So then, of course, the people would give them, because they thought that they were, English aristocrats, and knew all these people with money and everything, they'd give them the 50 grand, and then they would never do anything to help them raise money. They would just take the 50 grand, and then they'd run away. And has anybody ever encountered somebody like that in New York City? There's an entire economy of finders and brokers and investor relations and public relations people who get these payments for helping you to raise money, because you don't know how to raise money. And you didn't think to ask me how to raise money, so you just found these people and then signed a little agreement that says they get 3% of the deal, or 5% of the deal, or 10% of whatever they raise. And unfortunately, if they're not licensed by something called FINRA, the Financial Institutions Regulatory Authority in the United States, then if the investors who the unlicensed finder introduces you to don't like the way the investment has turned out, they have a right to get their money back from that finder and from you, the company. They have a rescission right. So that means if you blow out your offering by giving tokens away to 50 finders all around the world, then potentially a lot of the money that you raise, all those people when the token drops in price could say, give me my money back, because you had this unlicensed broker-dealer. That's sort of an issue, right? Now, it's all great if the token keeps going up. It's all perfectly fine if the token keeps going up. So maybe if you just build the best platform there is, it just keeps going up, no problem. There's also this AML KYC issue. Now, a lot of people think, you look at the Filecoin offering, you look at a lot of other offerings that are done through licensed broker-dealers, and those guys care about their license, so they want to comply with anti-money laundering and know your customer rules, which apply to U.S. financial institutions like broker-dealers and banks. They have to comply with that. So they have to find out who the person is. Some of them, need to get a copy of the passport to verify that it really is that person. It's whatever information they require to verify the person's identity. And then what they do is they do some checks in the background. They check it against the OFAC list, the Office of Foreign Assets Control sanctions list. Because as you know, we've sanctioned a bunch of people like Russians, North Koreans, Iranians, Syrians, Iraqis around the world involved in, what the government has deemed nefarious activity, whether it's money laundering, human trafficking, arms dealing, invading other countries, genocide, whatever it is, right? So you don't want to take money from those people, because then you're criminally exposed. Like you've taken money from a criminal and you're laundering their money, right? So an operational company building some software, like prepaid software, selling tokens as prepaid software, is not probably intending to do any money laundering, right? And so therefore there's not a set of regulation that requires the software company to do AML KYC, but it probably makes sense to do a little bit of that, to verify where the person's coming from, and then just have somebody check the OFAC list. Because if you receive certain types of currency, especially US dollars, from someone on the OFAC list, then you could be, held criminally liable. Now, usually they don't go after people like you. is the good news, right? They go after people who are really money laundering a lot of people's money. But when your offering gets to be $50 million, it might look like money laundering. That's all I've got. Any questions?
Let's have a big round of applause for Joe, everyone. Woo! Thank you, that was excellent. So first question down here, I'll bring the mic over so everyone can hear it. Here you go.
Thanks, Joe. That was great. Especially since things are changing so much.
Yeah.
Well, okay. So now versus last summer, if you have a utility token offering and you decided last summer, okay, I'm going to sell it not as a security and et cetera, versus kind of the best practice that you give now, what's the difference in cost and speed?
I think most of the work done to get the money raised is not impacted by these changes in securities laws, because before you do the token sale pursuant to something called the token sale agreement, and now you use something called the SAFT, and you have to make decisions about like what's the price in the pre-sale going to be, what's the price in the ICO or the final sale going to be, and things like that, and what's the discount going to be? Am I going to give bonus token? But all those questions are still the same, right? How am I going to market the offering? Who do I talk to? Who do I pitch in front of? What forums do I go to pitch at? Those are all not affected by this, right? Because again, most of the people that go to those forums that you would be pitching to, that you want to pitch to, are accredited. So I don't think it really significantly impacts. What it may impact, the SAFT with a 1-year holding period concept is going to be more attractive to sort of a venture style investor or a person who's just trying to diversify out of the currency of their country, like people in the PRC, for example, or in Russia. They just want to move their money overseas, as opposed to short-term traders, right? Who are trying to get the pre-sale ICO at a discount and then flip it in the aftermarket on Kraken within 2 months. That's a game that's been played, it's sort of done, at least by Americans right now. Yeah, so in other words, that the difference is that if you have, as long as you have sufficient demand from sort of the fundamental investors or the venture type investors, then same speed.
But the legal costs are the same?
Yeah, about the same. Yeah, about the same. Maybe less. Maybe less in the long run. Yeah.
Well, okay. The city's covered. But
Yeah.
the SAFT itself is getting standardized enough so that it's
Oh yeah.
it's not a super legal intensive.
Yeah. Yeah. You should not listen to the quotes of like 250 for an ICO, 250K for an ICO, or even probably more than 50. I would say. Some people are still doing that, but you should not buy that.
All right, we got another question here in the back of the room.
Hi, sorry I came in a little bit late. It was a great presentation from what I saw. The question I have is, to the best of your knowledge, how is the SEC treating offshore issuances of whether utility tokens or securities that are not directed toward U.S. investors?
Yeah.
Reg S wouldn't really apply if it's initially an offshore offering. And then I guess the answer to this may be obvious, but the second part is, what happens then when a U.S. coin exchange begins trading in those same securities off the secondary market?
Well, I think your first question is, how is the SEC treating sales of tokens to people overseas pursuant to Reg S? And the answer is basically that's out of their jurisdiction, and that's why they don't really treat it as very much at all. What they're concerned about is resales back into the United States within 1 year. And unfortunately, given the sort of blockchain basis for cryptocurrency, it's very difficult to put the typical types of restrictions on retrading into the U.S. that you put on common stock or preferred stock that's traded on an exchange, because in the contemporary paper-based system, there are all these controls that actually put physical legends on the stock certificates that prevent them from being traded back into the U.S. And the people at the exchange and the broker dealers that execute the trade will spot that and they'll not execute that trade. But with a overseas exchange, like I said, people can sell their tokens there back into the U.S. within 1 year, and nobody really even knows about it, right? Not to mention, what was your second question?
second question was, what happens when those same tokens get picked up by a domestic exchange? But I think the qualifier to my first question would be, and I don't know whether Reg is replying in this case, where you have a offshore entity, a non-US entity that is issuing the tokens originally.
So the U.S. doesn't care. The U.S. doesn't care about the domicile or the residence country of the issuer. It cares about the where the sale is made or where the offer is made. So in other words, if you have a Cayman company or Gibraltar or Swiss or Singapore company selling tokens into the United States, then everything I said, or SAFTs for that matter, into the United States, everything I said still applies.
All right, next question, right here up front.
What if strategy would be to do two kind of tokens? Do kind utility token to sell it to the United States, and the security kind of token to sell everywhere else. Does it make any sense?
I don't really know what that means, but there's no problem with issuing different types of tokens to different regions. Doing it by smart contract and geolocation. You can do it whatever you want. I'm not sure if that exact thing that you mentioned works. I think you would want to issue the security token into the U.S. and utility else. So what you typically do is a SAFT offering here in the States, and then you can do a simultaneous token offering overseas. And then it's really the company's issue, as opposed to me, the U.S. lawyer, as to whether or not they're complying with the rules of other countries. But generally, token offerings continue to be made in the other countries without any significant regulatory action, it seems.
So I actually have a question. So in what situations would you recommend that a founder goes this route over traditional venture capital or angel investing?
I've seen it come up in a number of instances where, for instance, the company, although it has great ideas, it's gravitating towards blockchain. Blockchain is perfect for their software, but they just can't raise venture or angel because of any of the various numbers of reasons why they have difficulty doing that. Whether they can't pitch they raised a bunch of money at a super high valuation, nobody wants to give them another shot, and then because they've already spent all that money, and then also. If you just want the various benefits of this and to still achieve effectively the same outcome, which is you're not selling equity, you're not diluting your own ownership, but you are raising the money required to build your project. And that's really what it's like. It's like project finance, right? You're getting investors just in that platform or that project. They don't own anything of your company. But at the same time, when you raise money in that way, how do you integrate some kind of a cash flow stream back to your company from the platform, right? And a good example, and I think an analogous company is Red Hat. Linux, they created this open source operating system, Linux, and then they charge like on a freemium basis, or basically a premium basis, like add-ons and modules, and now they have 700 million revenue. So they built this Linux thing that's free, a free, open, independent platform. You can play around with it, do whatever you want. Here's $700 million worth of add-ons. So maybe that's how you have to think about. I think you have to think about that in advance, before you just like build a platform that doesn't make any money for you, right?
Yeah, all right, cool. Great example with Linux. Next question.
Follow-up question. If you were conducting an offshore offering of a token or encrypted asset, what jurisdictions, in your view, are best suited to do that or have been doing that are easy to work with?
I usually just go for a global offering, excluding PRC, South Korea, Iran, Syria, Russia, North Korea, the usual suspects, because those are the countries that we have restrictions on, many, many different sorts of transactions with.
Can you talk about the scenario or method when a coin or a crypto you make it and you don't have to go through ICO? Because I know one of my friends he made a coin, but he just went directly onto exchange, and he said that way you can avoid some legal issues. I just want to know which way is better.
Yeah, you mean like-
you already have some investor upfront, because when
Yeah.
I read some white paper, I saw some ICO company, they already have a bunch of investors that already invested. So why do they still risk to raise money if they can just start with the exchanges? Then you
Well,
can still,
I mean, if you're already fully funded and you can build your platform with the money that you've raised, if you already sold your equity or borrowed money through debt, and that's already done, you can just airdrop, I think is the concept, your tokens, and create a market with your platform using those tokens without ever conducting a securities offering. And then, of course, you are avoiding the risks of that offering. So it's just up to you if you want to raise additional money with a token offering or not. That works fine to do what you said.
But if on blockchain, if more and more of your crypto is being created, then you are still raising money. Like you're letting more people buying your crypto. Then do you get what I mean?
I think what you're saying is that if more and more people are using the platform, and so therefore the demand for the token is higher,
You're still raising the money.
the price is going to go up.
Yes.
And if you had
And more coins
if
circulating.
you gave
in the
tokens to
market.
yourself, like in the management team or the stockholders, then you're creating value in your own tokens. But there's no cash going to the company, right? From an increase in the value of the tokens, right?
She's saying maybe. It depends how much the management team held on to and starts selling once after the airdrop.
Yeah, the management team or even the company itself could have tokens in the treasury. Yeah. I don't know. I have to think about that one.
Some are saying that could also present some trouble in the future. I know that's currently the best practice. But what setup do you still recommend when you have at least, let's say, the foreseeable future, you would be considering accredited U.S. investors, but also international investors? Would the SAFT still be the proper structuring for it?
Yeah, I just said that.
Okay.
You could sell the SAFT to accredited U.S. and then a SAFT also to non-accredited or any foreign purchaser. And when you say that people have identified problems with it in the future, I'm pretty confident those problems will be resolved. And the key is that all the current problems are solved, in my mind. Go ahead.
How's it going? I've got a question for you. So what would you recommend for a company that has already a built-out platform? Advice there?
Yeah, I mean, you can still do a direct token sale if you're absolutely certain that your token is not a security under these new under the guidance provided by these new enforcement actions like Munchie and the DAO and the chairman's report. But you have to, you should be really confident. I think what most people do is they get a legal opinion, a very expensive legal opinion, because and a highly qualified legal opinion. So then, really, what is it worth? And then keep in mind that when you do that kind of direct token sale, it is immediately then tradable. So then you're going to have a public float, and I have some companies that send me every blog post, every tweet, every press release for review because they don't know how to write those yet, and they don't want to be manipulating the market in their own tokens, which has a $300 million market cap, much like a small cap public company on NASDAQ, right? So you take on a lot of burden that way very quickly. And the airdrop thing that she was talking about, that's also possible with your model.
All right, we got time for one more follow up real quick.
Quick follow-up. So, in that case, if you were to do a pre-ICO and then just have that holding period for a year, 2 years, 3 years, whatever, just as you work with it, say, traditional.
Yep, you could do a token. We call it a SAFT, but if you did a token sale and part of the terms of that sale were that we're not going to give you the tokens for a year, or the earlier of the year in platform launch, or later of the year in platform, then you're achieving sort of the same thing, right? So there's many different deviations from the most conservative pathway I provided, but that's the basic idea.
All right, we got time for one more question. Who wants it? Anyone? Yeah, go for it.
Have you seen any deals that could, or ICO issuance that could compete with like the traditional securitization markets, like mortgage-backed securities, auto loan securitizations?
Yeah, I see a lot of those.
Okay, thank you.
All right, thank you. So with that, I want to say a big thank you to Joe Daniels from McCarter in English. So one more round of applause. Thank you. We're going to hang out up front here for probably 10 or 15 minutes. If you do have any questions, feel free to come on up. About legal, Joe's here. About Founder Institute, I'm here. And thank you for coming.
Thanks for listening to Ambition Today. Be sure to visit syscar.co to get all the information from this episode and more great content. Until next time, stay curious, everyone.